IRS is seeing that. Let's say, for instance, you've had expenses all along and now all of a sudden you don't have any. That's a red flag. If you did not amortize, like, actually, how can you have all this research and development activity and then all of a sudden you don't have any? The IRS is actually using that as a target. With that said, there are a couple of ways to go back and change this.
Welcome back. We're joined with Kim Lockridge from Engineering Tax Services. She's here to educate us on the new tax law changes for research development credit. I'm excited to have Kim share her wisdom and experience with us and to tell us where we've been, where we are, and where we're going. Welcome, Kim.
Hi, David. Thank you so much for having me back. I really appreciate it. It's always good to chat with you and get caught up with the research and development tax credit. It's been quite the ride because in the Tax Cuts and Jobs Act that came out in 2017, we ended up having a sunsetting of, not really a sunsetting of it because it's a permanent tax credit, but what they had done in order to get it passed is they implemented a provision in there that starting in 2022, we would have to amortize the R&D tax expenses that contribute to the R&D tax credit. The credit is not amortized. So I think there's a couple of myths that we need to put to bed before that, because I think what happened was a lot of people said, I'm not going to do the R&D tax credit because we have to amortize the expenses. Well, the credit is still based on the entire spend for that year. The credit did not change. In fact, the fact that the expenses that went into that 174 classification having to be amortized now over 5 years created a lot of misconceptions and misunderstanding, and they thought the R&D credit was what was being amortized. So just to clear that up, the credit remained the same. The amortization came in all of the expenses that fed into the calculation for the research and development tax credit. What was happening is, let's say if you have $1 million of payroll, for instance, W-2 wages, those people contributed to research and development activity. Then what happened was, normally, as you know, as a business, we would be able to expense the cost of the employee, right? The W-2, it's an expense on payroll. What happened was, if those hours were contributed to research and development activity within the business, now you cannot take an immediate deduction of that. You have to amortize that over 5 years. So that $1 million deduction that you would get in year one would now only be worth $200,000 every year for 5 years. Now you'd still get the $1 million, but you have over the course. So you're paying out $1 million in payroll plus some, but you're only getting to deduct a fifth of it. Okay. So what ultimately happened is a couple of different things. We've had companies that just stopped doing R&D. They would not classify it in the 174. The 174 expense is very specific to research and development. Any research and development activities, if you're developing a new software, if you're developing a new product, you're going to have expenses that are research and development related, whether that is subcontractors that you hire, employees, W-2 wages, supplies that are used, consumed, and are destroyed. Those are all the things that contribute to the expenses for research and development. They get put into this 174 classification. Now, of the 174, if it qualifies for research and development, so even if you hired somebody in India, for instance, let's say you hired somebody in India to do some coding for you, it's research and development of a new product or a new software that you're developing, those would have to go into a 174 classification. Then if now foreign expenditures are not qualified for the research and development credit. So what happens is there's a subcategory of the 174 called the 41. If it qualified for the expenditures for research and development on U.S. soil, those subcontractors that you hired, then it would slip that expense into a 41 instead of a 174. Okay, so now it's like a subcategory. And everything that went into a 41 bucket, a 41 expense, be a part of the R&D tax credit. The R&D tax credit had a filter of what it qualifies, what doesn't. Needless to say, anything that goes into that 174 bucket has to be amortized. All of those costs, those expenses. That was very detrimental. We expected fully that by 2022, that would have been repealed. It was not. We expected in 2023 that that would be repealed. It was not. In 2024, we had the American Workers and Families Act, and it was supposed to be repealed. It was not, it did not pass. This was a bipartisan desire. It was something that we expected to go away, but because it was coupled with some controversial things like the child tax credit and some of the other issues, that caused it to not pass. Finally, in 2025, and not until July 4th, did we end up seeing that the R&D tax credit, not the credit, the R&D expenditures, the amortization rules surrounding that started in 2022 was repealed. Okay. So what does that mean? Where we're at now is that we've had a lot of people maybe that did the tax credits in 2022 realized they had to amortize. They didn't want to amortize. Obviously, nobody wants to do that, especially after being able to take the deduction for it. But ultimately, we had people that do have research and development activity choose not to classify it in a 174. They were putting it into a 162 expense. And that is in violation of the compliance of the IRS regulations. If it's research and development activity, it must be put into a 174. We have a lot of issues with companies right now, and the IRS is seeing that. Let's say, for instance, you've had 174 expenses all along, and now all of a sudden in 2022, you don't have any. The IRS, you should know this, David, because you were there in that seat. Now that's a red flag. Now, if you did not amortize, like actually, how can you have all this research and development activity and then all of a sudden you don't have any? The IRS is actually using that as a target. With that said, there are a couple of ways to go back and change this. The government has given us a threshold and above 31 million in revenue and a below 31 million in revenue. With that said, the companies that are above 31 million cannot go back now that it's been repealed. Essentially, you can take the remaining amortization. So if you started amortizing in 2022, you would have amortized 22, 23, 24. Now you can bring forward the other 2 years that remain. In 2023, you'll have 3 years that remain. In 2024, you'll have 4 years that remain. The remaining amortization amounts can now be taken fully as an expense in 2025, or you can choose to split it between 25 and 26, only going forward. If you're under 31 million, you can do a Form 3115 to take the remaining amortized expenses for those 2, 3, and 4 years, and you can bring those into the 2025 tax year. You can file an amended return and you can fix it back then if you want to get refunds from taxes that you've already paid, but you'll get them going forward. You can also choose to split that between 25 and 26. So that's the challenge. That was really long-winded, David, but those were the challenges that we faced, the history of what brought us to where we're at, and where we're at today on how to fix it. Was that helpful?
This is a great exercise in the details and in the nuance, as the tax code is very complicated. And that's why we need specialists like Engineering Tax Services and your team, Kim, to help maneuver through some of this minutia and not doing it all ourselves and having a team. It's crazy because, as you were mentioning, when people get those notices, especially in the AI world, they're going to be scrambling. People are scrambling. We'll send out a notice saying, prove it. Because if you can't prove it, you lose it. And research development, cost segregation, these types of things create large, unusual, questionable items. It becomes a red flag. It potentially can. So we got to be documenting. Kim, I have a question about, should we go back and amend or just do the 3115 form and get that credit and that lost money now? What's your recommendation?
I would run the numbers both ways, right? I would have your CPA go back through and run a pro forma if you choose to amend versus doing a 3115 and waiting until 2025 and bringing those. It may just be a simple choice that you have more taxable income in 25. So it just makes sense to do that. If it's evens, I would choose not to go back and amend for obvious reasons. I mean, anytime you have a second set of eyeballs on a tax return, it's not recommended. So if you can prevent that, I think the 3115 is probably the ideal choice. But if it's a significant difference from getting a credit back from the IRS, then I would consider amending depending on the difference between the two and also how long it's been since you filed. Another factor to that is that if you always file an extension, you're not going to get the money back or realize those benefits until the fall. So you kind of want to think about if you need cash flow, you might need to go back and do an amended return. So just run the numbers with your CPA and see what's best for you. It's going to be different for everyone.
There's so many things that can go wrong. It's crazy. It drives me nuts because there's a lot of mills out there, a lot of people who are saying that you can take research development credits, and it's just not true. It's just not that easy. I have chiropractors or doctors, and they're saying, oh, you can deduct something, you can do the research development credits.
Yeah.
And really, it's not true because there's a lot of false information out there. Those people aren't signing the tax returns, and that's why working with Engineering Tax Service, Kim and her team, is so valuable because they have the due diligence. They've been doing this for decades and decades, and they do good work. They stand behind it. They dot the I's and cross the T's, and this is why I love working with Engineering Tax Services, and this is why you need to get a hold of them and schedule a time to get on their calendar.
Engineering Tax Services, we substantiate the credit. We ensure that you have met the 4-part test. There's also a couple of requirements that you have to prove risk. You've got to prove that you own the rights to the product or the process. I mean, if you're hiring a subcontractor to come in and build you a software, do they own the rights to be able to go in and duplicate that for somebody else? Or do you own the rights that they cannot do that? That is a huge factor of part of the qualifying of research and development tax credits. This is the problem with the R&D tax credit. They do make it very complicated on purpose. It's not going to be that easy. You have to prove certain things. And remember that the research and development tax credit has been around since 1981, right? This is not a new credit. So it has changed and morphed over the years. And so what happens is you have these rev procs and you have these acts and you have these bills that come in, like the PATH Act, that says, hey, in 2016, if you have revenues less than 5 million and you're a startup company and you've been in business less than 5 years and you can't use that tax credit, we don't want to discourage you from taking the tax credit. We want to give you the opportunity to do that, but now you can offset your payroll tax because you can't use it federally. So these are the things that the government is helping with and making it a little bit easier, but there's still a substantiation to the credit, and that's what's important. Yeah, that's right. Fantastic. I really appreciate being able to chat with you today, David.